This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
Steve Lentz here. Thank you very much, Jeff. And I assume you can all hear me, right? I'm looking at the thing, and I see all these green dots flying around, so I guess you can hear. Excellent. Okay. Here, let's get going. There we go. All right. Yes, I'm Steve Lentz. I'm with Discover Options. We are the educational arm of OptionView Systems. We have a software program that analyzes options, and part of our education program involves getting into directional strategies. Now, we focus primarily on non-directional strategies in our mentoring program, but something we do quite a bit of is we get involved in directional stuff. Okay? And I'll kind of backing up here. Go ahead and save your questions for the end. I have a lot to get through. So if you could just kind of hold off, and maybe I'll answer it as we go along, okay? And then we'll save it for the end, and I'll get through this, and then I'll do the best I can to answer your questions. And so one of the directional approaches we like to talk about and observe and just see how it does over the years, we've been monitoring this approach for quite a while now, involves the directional movement indicator. Okay, and this is a way of determining trend. And in the world of technical analysis, we look at trend in the way kind of like that Newton did. That which is in motion tends to stay in motion. That's the belief that in many systems trading systems, you want to trade with the trend, in the belief that which is in motion tends to stay in motion. Okay, now we can measure trend in a variety of ways. Okay, gotta click the arrow there. But what we're going to look at today is 5 different items. What is the DMI? We'll look at ideal option spreads to combine with the DMI signals. We'll look at a detailed DMI trading plan. We'll look at some testing results, and then I have some MetaStock formulas to show you so that you can use an expert and then scan the markets as well. Okay, so we're going to get through this, and then I'll take questions as well best as I can at the end, okay? All right, so without further ado, let me see here, going to the next arrow. DMI stands for Directional Movement Indicator. Okay, now what we're talking about here in the broad topic, the title here is a DMI Credit Spread Trading System. DMI Credit Spread Trading System. So the DMI stands for Directional Movement Indicator. This was developed by Wells Wilder in a very important book written in the 1970s called New Concepts in Technical Trading Systems. That book introduced lots of different new ideas at the time, but which have become really main staples for systems that, MetaStock and other programs. You'll find just the stock items, ADX, DMI, you have relative strength, the RSI, average true range. He introduced some concepts before he had really computers to help him. So what's interesting is when you look at his book, he has all these spreadsheets, and you could see how every day he would calculate it. And he devised his weighted system so that it was easy to keep track of day by day and didn't involve, getting a new calculator, a new calculation every single time. Okay, so that's what the DMI stands for. Very good. All right. When you bring up in MetaStock the DMI, all right, in the family of the directional movement indicator, you also have the ADX, and that is represented by the black line. Okay, so there's the green line, the red line, and the black line. Okay, now these are derivatives of price, and really, backing way up, what's an advantage of an indicator? Okay, why would you throw an indicator on at the bottom of a chart? Well, it's a way of interpreting price to kind of cut through all the mess that price action can give us. Okay, it's a way of interpreting price and putting things into simpler terms that we can quickly see trend, for example. Okay, and you can also have indicators showing you pullbacks. Okay, but it's a way to simplify price action in a different way to see it. Okay, so the red line is the negative directional indicator. The green is the positive, and the black is the ADX. Now, in the world of the ADX, that's a whole family of trading approaches. Okay, we're not going to talk about the ADX. Okay, so please no questions about it because I've studied it to a certain extent. I'll tell you, I'm sure there are some of you here that know it far better than I do. But we're focusing here today on just the green and the red lines here. So I'm going to remove the black. We're looking at just the red and the green. Okay, remember the black ADX is a derivative of these lines. So the ADX really is a derivative of a derivative. These lines here are a derivative of price. The ADX is a derivative of these lines. Okay, so we're going to remove the black line and let's look at these. Okay, now to get to those lines, we're going to look at trend determination. And typically, what you'll see out there used most often is a moving average of the close. So you look at all the closes here, you average them up, and then you have a nice moving average. And if price is above the moving average, we have a positive trend typically, right? Okay, now the ADX or the DMI approach, the directional movement indicator, takes an entirely different angle here. Okay, we're coming around, we're looking at it from a completely different direction, a different perspective. And so this approach addresses, I wrote down these words to get it precisely right, it addresses the largest part of the current trading range that lies outside the previous trading range. Okay, once again, the DMI addresses the largest part of the current trading range that lies outside the previous trading range. So here, let me get my little tool here. See how we do. All right, so let's go over here to this bar here. You see this? Oops. There we go. Let's try that. Okay. Here we can see that when we're looking at this bar here, okay, this portion of the trading range that lies outside the previous is larger than the one underneath right here. See that? Okay. So, as it is for all the others, you can see that I highlighted in green and red the areas of the trading range that were greatest that lies outside the previous. And that's what the DMI addresses. That's what the DMI addresses. It's not looking at a moving average of close. We're coming at it from a completely different viewpoint. So that's why I really like this, is that it's a completely different perspective here. And you don't have to be a Poindexter to understand this, okay? Just keep an open mind, and we're not going to get into the nitty-gritty of the formulas, okay? I'm going to give you a broad overview so that we get the general gist of things. Okay, I'm not going to, give an example of calculating a specific one. I want to give you a broad brush overview so that we can appreciate, what this indicator brings to the table. I think we're okay with that. All right. So, step one in determining the DMI, okay, we first determine, all right, the largest part of the current trading range that's outside the previous. So just like here, we have 5 points here and 1 point here. Now, in the world of calculating this, we're going to ascribe the positive directional movement, that level, 5 points in this case. And because the other one was less than that, we're just going to give that a 0. We're just going to give that a 0. Okay? And we do that for every single day that goes along. So then the next day comes and goes, and you'll see that we have 6 points for the negative directional movement. But because this one was not outside the previous range, it doesn't even count at all. So we give that just a 0. So now, start moving along day by day, you can kind of see, you start racking up these values. It's going to be either 0 for that day or a positive number. All right, so each one of these builds, and so when we calculate negative or positive, the green line or the red, we have to either use a 0 or that day's positive number. Okay, that's how it goes. So once we have that, we have this series of values for the positive and the negative. Rather than just averaging those up, okay, Wilder did something very interesting. He wanted to normalize it relative to the range, the trading range, the average range for the days. So the second step, okay, is that we have to determine the day's true range. And so an average true range is the largest of either of these three things: today's high minus today's low, today's high minus yesterday's close minus today's low. So once you do that, you can see that for this day here, okay, we would have used the first one, today's high minus today's low. That was 30 points, would have been that day's average true range. The next day comes and goes right there. And the largest of those three, in this case, would have been the third one, yesterday's close minus today's low. That would have been that day's average true range. Okay, now we're going to use that to normalize what we looked at previously. And when we do, here is the formula to get the positive directional movement or the negative directional movement. So the green line, and 14 is typically what we use, a 14-day average. That's the default setting. I got to tell you, though, for our purposes, we're going to use a 10-day because that'll give us a few more signals per year than using a 14. But I'm showing you 14 because when you bring it up in MetaStock, you know, you're going to get 14 as the default. Okay, and that's kind of what Wilder used as well. Okay, but what we do is we take the weighted moving average of that positive DM number, remember the zeros or the sixes and all that, divided by the 14-day weighted moving average of the true range. That gives us the green line value. Okay, use the same approach and we get the red line value for the negative. Okay, and what you'll get then is a series of lines, green and red, all right, shown underneath the price. And you can kind of see here, when price is going down, that's when we have the red line above the green. Price is going up and we have a positive trend. That's when green is above the red. Okay? Real good. Now, how do we get trading signals? How do we get signals from this? Well, what we're going to do is have a setup bar and then an entry trigger. So there's a setup bar that occurs and then an entry trigger. And that trigger is something Wilder came up with that's very important, and we're going to show you why. But we first must have a setup bar that occurs when the lines cross. When the lines cross, we get a setup bar. Then we wait till the next day. If price surpasses the extreme value, then that is our entry trigger. That's when we jump in right there. I'm making a mess of this. Sorry about that. Okay, so setup bar and an entry trigger. So let's dive into this further here. We have the setup bar that occurs, and you can see right here that we have the green line crossing above the red, and we have a setup bar, a bullish setup bar right here. Okay, let me go on. There we go. Then on the very next day, we have a reversal that occurs. The red crosses back above the green. Now, notice what happened is that there was no entry trigger. We need the price to surpass the extreme value. When we had that bullish setup bar, did price exceed the high of that bar to the bullish side? No. There was no bullish entry triggered for that first setup bar. However, for the second bar, the bearish setup bar, we did then the next day have a bearish entry that was triggered, and when that next day descended below the low of that previous bar, bing, that's when we go in. We're going short. Okay, in our case, we're going to sell a call spread.